Welcome to the deep dive. Today we are unpacking an assessment that is so dramatic, so fundamental, it suggests that every single one of you listening needs to immediately rethink your entire financial strategy for the next decade.
That's right. And we're not talking about gradual, incremental change here.
Not at all. The analysis we've synthesized shows we are living through the biggest global architectural shift in, over 100 years?
At least. And that's really the consensus view emerging from leading geopolitical and financial commentary. It's a sober assessment, but it's a necessary one.
So when we use a term like global architecture, let's be clear, we're not just talking about a standard recession or a market cycle.
No, absolutely not. We mean the foundational operating system of the world. I mean, how wealth is created, how military power is structured, and the technological standards that, underpin global commerce itself.
And this whole transition, it's being driven by a convergence of crises, isn't it? It's finance, it's tech, it's military conflict, all at once.
All at once. It's a synchronized crisis, and it is actively setting the stage for a new world order. Period.
Okay, so let's unpack that. We've really immersed ourselves in this body of analysis, and the mission for this deep dive is sharp and targeted. It's not just about listing the risks,
Which are massive.
they are massive, and they seem to be peaking around 2026 and 2027, but it's about recognizing this volatility, this extreme upheaval, as what the source calls the 100-year opportunity.
This is the crucial mindset shift. Our focus today is on winning the game. Because if you study history, you learn that the people who really shape the world, we're talking major financial institutions, powerful, highly informed families, they don't just survive crises.
They thrive on them.
They use them. They use them to consolidate and grow their wealth exponentially. They see widespread panic, fear, asset liquidation. They see that as a purchase order. They are running a very specific playbook.
And that's exactly why this deep dive matters to you right now. If your current focus is just on surviving the market noise, weathering the storm, or, hoping things go back to normal.
Then the analysis suggests you've already lost the game.
Exactly. We need to stop reacting to the day-to-day market swings and start understanding the underlying system architecture. We need to think with the frameworks used by those who control the system.
It's about anticipating the reset and positioning for the massive wealth transfer that always follows.
So let's dive into the core mechanisms that are collapsing the old system first. Because without understanding the problem, you really can't see the opportunity.
Let's do it.
We'll start with the economy, because from the outside, the view is, well, it's very confusing. You see the so-called Magnificent Seven tech stocks hitting all-time highs.
Right.
It looks like an economic boom.
It does. But our sources suggest this extreme concentration is a mirage. It's masking a deep structural rot in the actual physical economy, what they call the zombie economy.
That distinction feels incredibly important.
It's paramount. The global economy is, right now, basically being held up by maybe 15 high-growth firms. You've got the Magnificent Seven, a few key chip manufacturers, some specialized AI firms. But if you look just beneath that very thin layer, you look at the rest of the S&P 500.
So the other 485 companies.
The other 485. The companies in traditional sectors, consumer goods, manufacturing, retail, the picture changes completely. Many of these are what we call zombie corporations.
And a zombie corporation is what exactly? It's not growing, but it's not dead either.
That's it, precisely. Their profit margins are stagnant or falling. They're not really growing. But crucially, they haven't gone bankrupt. They're kept artificially alive because they rolled over massive amounts of debt during the last decade of ultra-low interest rates.
So the whole market cap of the index looks healthy because 7 or so giants are carrying all the weight. But the underlying economic health, the jobs, the productivity, real capital investment is actually very poor.
It's incredibly poor. And all that money is concentrated in way too few assets, which makes the entire system just incredibly brittle. It's hypersensitive to any kind of interest rate shock.
And that fragility, that brittleness, you see it most acutely in Europe.
Oh, absolutely. Europe is the most advanced case study. After the conflict in Ukraine, the high-cost economic environment, especially for energy, is just crushing core European industry.
I saw a figure, something like a 40% jump in energy costs.
40% across the continent. It's unsustainable. And while, attention often focuses on the UK or Italy, our sources identify the core structural flaw, the financial detonator that could cause the most systemic damage, as France.
France. That's surprising. I mean, we usually hear about Germany's export engine as the center of gravity. Why France?
It's because of these deep inherited systemic inefficiencies. They're rooted in post-World War II labor law. Since 1945, French labor laws have made it exceptionally difficult and expensive to fire employees.
So there's no flexibility.
Zero. So when an economic shock hits like a 40% spike in energy costs, businesses can't adapt. They can't streamline or cut unproductive overhead quickly. They're forced to carry these massive, inefficient labor costs, which becomes completely untenable when your revenue slows and your costs are spiking.
It's like a systemic brake on the entire national economy.
A brake on modernization, on business flexibility, everything. And that cost is now being compounded by a demographic time bomb that seems completely unavoidable.
The pension crisis.
The French pension crisis is at its absolute breaking point. When the system was designed, the ratio was roughly 4 active workers supporting 1 retiree.
Okay, that sounds sustainable.
It was. But today, that ratio has collapsed to 1.7 workers supporting a single retiree.
Wow, 1.7.
Which is mathematically impossible to sustain. It requires huge increases in contributions or a radical increase in the retirement age. And that's what fueled those massive protests back in 2023 when the government tried to push the retirement age from just 62 to 64.
So the analysis suggests that without some kind of radical, probably externally imposed change, France is heading towards sovereign bankruptcy.
It is. And given how interconnected the EU financial system is, an event like that could absolutely pull Germany, the EU's anchor down with it. And then you have a full-blown regional sovereign crisis on your hands.
That potential crisis in Europe really sets the global stage. But the single biggest concern in the sources we looked at, the domestic risk that really occupies the system analysts in the West, is the U.S. commercial real estate time bomb. The CRE issue.
When analysts talk about systemic risk right now, this is number 1. Full stop.
And they're not mincing words about the scale, are they?
No. Our source claims that the magnitude of this combined CRE and private credit risk could be up to 5 times larger than the 2008 subprime mortgage crisis.
5 times. Let's just sit with that for a second. That's not a correction. That's a systemic threat.
It's a threat to the entire U.S. banking structure.
Yeah.
We really need to understand the mechanism here because it's this confluence of really bad timing and just plummeting valuations.
So walk us through it. What's the core of the problem?
Okay. Over the next 2 years, centered specifically around 2026 and 2027, you have this massive debt wall maturing. It's approximately $1.88 trillion worth of 5-year commercial loans.
Loans for malls, office parks, that kind of thing.
Exactly. And these were all issued back in the early pandemic era when interest rates were at historic lows. We're talking 2.5%, maybe 3%.
So now they have to roll over this massive debt wall, but at today's much higher interest rates.
Exactly. The principal has to be rolled over at 6, 7, maybe even 9%. But at the same time, the underlying collateral, the buildings themselves, has been devastated.
The work from home trend.
That's the big one. Office occupancy is low, and it seems to be permanently impaired. Plus, you have traditional retail spaces like malls that are just struggling to survive. So CRE property values are now, and this is a conservative estimate, down 40 to 60% from their peak.
And here's the part that breaks the system, right? If the bank agrees to roll over the loan, the owner has to inject a huge amount of new cash because the building is now worth so much less than the loan itself.
Correct. The bank has to stick to its loan-to-value ratio. So if you have a $100 million property that's now only worth $50 million, the owner has to find tens of millions in cash to cover that shortfall.
And they just don't have it.
Most commercial property owners simply don't have that kind of liquidity. So if they can't inject the cash, they default. And the bank has to seize the asset at a deep, deep loss.
And critically, this debt isn't sitting on the books of the 4 big Wall Street banks.
No, that's the crucial distribution risk. The major firms offloaded this type of lending after 2008. This debt is spread across 1,480 regional U.S. banks.
1,480?
Yes, and current regulatory stress tests suggest that 580 of those regional banks are already at high risk of failure. They're showing the same vulnerabilities as Silicon Valley Bank or First Republic, but on a much, much larger domino-like scale.
You mentioned private credit earlier. How does that, the shadow banking sector, how does that amplify this whole thing to be 5 times subprime?
Okay, so private credit is just non-bank lending. These are large funds, firms that operate outside of the traditional banking regulations. They were often the ones who provided the initial equity that the CRV owners used to buy the properties in the first place.
Ah, so it's a double hit.
It's a cross-collateralization nightmare. When the CRE owner defaults, it doesn't just hit the regional bank holding the main loan, it simultaneously drags down the private credit funds that loaned the equity. So you're hitting the regulated banking system and the unregulated shadow banking system at the exact same time, which just multiplies the systemic shock.
So if the regional banks are collapsing under all this CRE debt, that suggests the Federal Reserve's tools aren't working the way they're supposed to.
They're not. And that brings us to maybe the biggest indicator that the whole U.S. financial system has lost its anchor: the bond superpower reasserting itself.
Explain that. What does that mean, the bond superpower?
This is probably the most dangerous sign of a systemic breakdown. The Fed is demonstrably losing its control and authority over the bond market. For decades, the central bank dictated the terms of debt and interest rates. Now, the market itself is leading the central bank. It's a complete reversal of how things are supposed to work.
And the proof is in the market's contradictory actions.
Precisely. You see a direct contradiction of conventional monetary theory. The Fed cuts rates or signals a pause in rate hikes, but the bond yields, specifically the long-term 10-year and 30-year yields, are rising. They're hitting new highs.
So why is that rising yield, despite the Fed's signals, such a red flag for market distrust?
Because it means investors are demanding higher compensation to hold long-term U.S. government debt. They're saying the risk is higher, so you have to pay us more.
So they're pricing in future risk.
They're pricing in inflation, massive geopolitical risk, and the increasing likelihood that the U.S. government will struggle to service its $37 trillion debt load. Especially as trillions of dollars old, low-interest debt has to be rolled over at these new, higher rates.
So investors see this structural problem and they're demanding more interest.
Exactly. This signal is very similar to what was seen in Japan decades ago, where the bond superpower, the market itself, dictates policy terms. It forces the central bank to follow rather than lead. And once the central bank loses control of the bond market, it effectively loses control of the entire financial system.
That's overwhelming financial fragility. It's not happening in a vacuum, is it? It's set against a backdrop of escalating global conflict. And our sources analyze these conflicts not as isolated events, but as highly coordinated proxy wars.
Absolutely. The conflicts we're observing globally, you have the obvious ones like Russia, Ukraine, and Israel-Iran, but also these increasing border conflicts near Thailand, the Philippines, Central Asia. They're all interconnected.
They're proxy wars between two major global blocs.
That's right. You have the established G7 NATO alliance on one side and the emerging BRICS-aligned powers on the other, which are expanding rapidly to include nations like Iran, Saudi Arabia, the UAE. The world is actively and very rapidly dividing into two competing, non-cooperative spheres of influence.
And these conflicts are being used to test the boundaries of these new blocs.
Exactly. And the conflict is fundamentally multidimensional. It's often fought through economic pressure and internal destabilization, not just conventional battles.
Right. You see these external forces trying to promote internal chaos, especially around the rival bloc's main power center, which is China.
Correct. Our source describes this as the Ring of Fire. If you just look at a map of the regions surrounding China, from the economic pressure on Japan and Taiwan to the internal political instability in Laos and Myanmar, the volatile military situation in the Philippines, trade wars affecting Pakistan, they are all experiencing deep internal political or economic volatility.
And the pattern suggests this is intentional.
The pattern suggests ongoing external interference. It's designed to keep China surrounded by volatility, forcing it to divert massive resources and attention inward rather than outward toward global expansion.
Let's shift back to that core structural problem facing the West, the $37 trillion U.S. national debt. Default is politically impossible, but some kind of restructuring seems necessary. What radical mechanism could the U.S. even use to handle that staggering number?
The only remaining weapon of choice, the dark idea that's being actively discussed in these top analytical circles, is leveraging the U.S. gold reserve. Currently, that's pegged at around 8,500 tons.
And there's a historical precedent for this, isn't there?
There is, and it's not ancient history. It's FDR's Executive Order 6102 back in 1933. He effectively devalued the dollar by requiring citizens to sell their gold to the government, which allowed the U.S. to instantly revalue the official price of gold from about $20 an ounce to $35 an ounce.
So the modern proposal would be something similar, dramatically revalue gold upward. But what does that actually achieve, practically speaking, against a $37 trillion balance sheet?
It's a mechanism to instantly increase the collateral base of the United States. Right now, at the current market price of gold, the U.S. reserves collateralize maybe 5% of the total debt.
Which isn't enough to inspire global confidence?
Not at all. However, if the price of gold were raised significantly, let's say to $10,000 an ounce, the perceived value of that 8,500 tons of gold instantly grows, and it could collateralize maybe 10 to 15% of the debt.
And some analysts are suggesting even higher numbers.
Some aggressive analysts suggest revaluing gold all the way up to $40,000 an ounce. That would dramatically collateralize the debt at around 40%.
So the U.S. wouldn't formally default. They wouldn't even declare the dollar devalued in the traditional sense. They would just announce a massive increase in the dollar price of gold,
which instantly increases the perceived value of their collateral and restores a measure of global trust in their ability to service future debt. It's a very elegant form of financial subterfuge, an instant, massive balance sheet improvement without printing a single new dollar.
And this move is seen as a necessary precursor to either rebuilding confidence or creating new gold-backed debt instruments, right? Especially as the BRICS nations move toward a non-dollar system.
It is. And it's important to note why something like Bitcoin isn't viable here. Its market cap is simply too small. Even at $100,000 per BTC, its market cap is only around $2 trillion. You can't back a $37 trillion debt load with that.
And crucially, it doesn't have the regulatory status.
Not even close.
Yeah.
Crypto doesn't hold the Tier 1 regulatory status that gold has enjoyed for over a century. Gold is the only universally recognized asset for currency stability.
Okay, this is where the split becomes permanent. Moving from finance and geopolitics to the foundational future. Our sources state it very clearly. The chip war is over.
It's over. The technology world has formally split into two non-compatible spheres, and one side has declared a path to complete technological self-sufficiency.
This feels like the most fundamental break in the system architecture.
It is. For years, the West focused on throttling China's access to high-end chips. But instead of giving up, China used that pressure as a catalyst to pivot its entire national strategy. They've separated their technological development path entirely from the U.S.
And now they're focused on building a fully integrated, cohesive national infrastructure, this smart city operating system for the whole country.
Yes, and we need to look at some concrete examples of how this ecosystem strategy translates into real-world change. The intention is not just to replace parts, but the entire stack.
Okay, like what?
First, within 2 years, Huawei's proprietary Harmony OS is set to replace Windows and iOS on all Chinese PCs, tablets, and mobile devices.
All of them?
All of them. This isn't just a market share shift. This means Microsoft instantly loses access to 1.4 billion customers overnight. It's a catastrophic declaration of technological independence and the total closure of the Chinese market to Western software.
That is a massive declaration. But the future of computing goes beyond operating systems. It's about the hardware and processing power. Where is China lighting there?
They're making significant foundational strides in technologies the U.S. is struggling to commercialize at scale. For example, they're pioneering analog AI.
Analog AI. How is that different from the binary AI we're used to?
Binary AI processes information sequentially using zeros and ones. It requires constant refreshing. It's very energy intensive. Analog AI uses continuous electrical variables and parallel processing. This makes it significantly faster. We're talking projections of 1,000 times faster for complex, continuous tasks like managing city-scale sensory data.
So binary AI is better for single, complex calculations, but analog AI is optimized for the continuous management of a massive, interconnected smart city.
Exactly. And it uses far less power and generates almost no heat. And they're coupling this with photonic chips, which use light instead of electrons to transmit data.
Which is another massive speed increase.
1,000 times faster than traditional electron chips. It also reduces power consumption and heat to negligible levels. They're moving beyond the current digital architecture into the foundational quantum age, and they're doing it with massive state backing.
And they have the brain power and the energy advantages to accelerate this divergence.
Oh, the strategic investment in human capital has paid off exponentially. The source highlights that 9 of the world's top 10 technology universities are now in China.
9 out of 10.
And in terms of dedicated research manpower, you look at a company like Huawei. They've scaled their R&D staff from 25,000 a few years ago to 150,000 today, all working in collaborative labs designed to produce everything from foundational research to cutting-edge 7-nanometer chips.
But the single most critical component for any technological leap is cheap, abundant power. How are they solving that problem?
This is China's trump card. They are rapidly building 6 new fission nuclear plants, and they've successfully conducted large-scale tests of thorium reactors.
Thorium. That's safer, cleaner.
Safer, cleaner, and the world has reserves estimated to last 20,000 years. It's a near-limitless supply of reliable power. This generates abundant, cheap electricity, which the government then uses strategically. They subsidize electricity costs by 50% for their semiconductor manufacturers.
It's 50%.
Which just crushes the Western competition on cost structure. It makes it impossible for U.S. firms to compete on price in the global chip market.
Meanwhile, the U.S. side is fragmented. We excel at the very top of the stack, peak, AGI research, OpenAI, and so on. But our commercialization and infrastructure seem disjointed.
That is the essential contrast. The U.S. focuses on individual, brilliant components like NVIDIA's top-tier chips, but lacks a cohesive national infrastructure. You see real-world issues like California's unreliable energy grids stalling the deployment of autonomous cars, even though the U.S. leads in the software.
So brilliant but fragmented.
Exactly. China is focused on exporting a full-stack, end-to-end smart city ecosystem model. From the operating system to the logistics and energy, all managed by their analog AI. The world is being forced to choose between 2 fundamentally different, non-compatible technological stacks.
But wait, a quick question on that. If the U.S. is leading that peak AGI research, which is where the ultimate value will be created, couldn't the U.S. eventually leapfrog China's foundational lead? Does focusing on the smart city OS limit their ultimate AI potential?
That is the core strategic debate, China is prioritizing stability, efficiency, scale, a predictable, centrally managed infrastructure. The U.S. approach is much higher risk, but higher reward.
So if the U.S. achieves true AGI first?
If the U.S. achieves true artificial general intelligence first, that intellectual leap could indeed render China's current infrastructural lead irrelevant. However, the expert analysis suggests that without a stable, optimized, and cheap power and infrastructure base, which China is guaranteeing, the commercialization of that peak AGI will be perpetually bottlenecked.
By energy scarcity, fragmented data.
Unreliable deployment environments. China is building the optimized rails. The U.S. is building a superior engine, but still needs stable tracks to run on. This dichotomy makes the next decade a true winner-take-all technological race.
Okay, so understanding these financial fault lines and the tech divergence can make the future feel overwhelmingly complex. But if we adopt that elite mindset we mentioned at the start, we realize these periods of chaos are just history repeating itself.
And that conflict is fundamentally a profit-generating exercise for the institutions that are positioned correctly.
That's the dark, uncomfortable truth of history we have to accept, isn't it? War is commerce.
It is. Conflict is the greatest trade in human history. And the winners are not necessarily the nations who sign the treaties, but the financial institutions that define the New World Order and, most importantly, restructure all the resulting debt.
No one loses from war.
Except the common person who pays the price in blood, in taxation, and in liquidated resources.
Let's focus on the World War I case study because it perfectly illustrates how these institutions create a self-funding, circular system of conflict and debt.
Okay, so consider the circular flow of money during and after World War I. Britain needed massive amounts of war materials. They rapidly ran out of gold and had to sell their reserves to the United States.
Okay.
To continue fighting, Britain then had to borrow massive amounts of money from powerful U.S. financial institutions, specifically J.P. Morgan, taking on huge war loans.
Right.
When the war finally ended, Britain demanded massive reparations from a devastated, bankrupt Germany. But Germany, of course, was destitute. They couldn't pay.
So the system needed a solution to keep the debt flowing.
Precisely. And the solution was the financial institutions themselves. J.P. Morgan financed Germany. They gave Germany the money required to pay reparations to Britain.
And Britain then used that exact money.
The exact money created by the financial institutions to pay back their initial war loans, plus hefty interest to J.P. Morgan. The banks created the debt, they financed the repayment of the debt, and they collected enormous interest and profits while the nations bled themselves dry.
That is staggering.
Yeah.
The entire system was just a massive, self-sustaining profit engine for the financial elite, with the war acting as the primary catalyst.
And this profit motive is not new. We see this pattern repeating across centuries. Look at the strategic financing undertaken by the Rothschild family during the Napoleonic Wars in the early 19th century.
What was the result there?
Through strategic financing of all sides and masterful use of insider information, the family increased their wealth from £20,000 to an estimated £50 million in just 17 years.
50 million.
A profit increase of thousands of percent achieved specifically during peak systemic conflict and political uncertainty.
And this mechanism is very much alive today. We can connect it right back to that looming French crisis we discussed. The analysis explicitly links this profit mechanism to the modern role of the IMF.
Exactly. When France inevitably reaches the point of needing an external financial bailout, the International Monetary Fund will step in. We've seen this playbook before. Thailand in 1997, Greece in 2010.
And the IMF doesn't just provide a loan, does it?
No. It imposes what are known as structural adjustment policies, or SAPs, and these are non-negotiable conditions.
So what are these policies and why do they matter for a country like France?
They force the receiving country to change its fundamental laws. They often require massive privatization of state assets, deregulation of key industries, removal of subsidies. For France, this means the IMF will force them to dismantle the very structural rigidities that caused the crisis in the first place, namely the entrenched 1945 labor laws and the unsustainable pension system.
So this is how the system dictates change, through a crisis that induces submission.
It forces a nation to rewrite its laws to the preference of the global financial architecture.
All right, let's pivot from systemic control to the individual playbook.
Yeah.
How do you capitalize on this crisis? We need to look at the Bond King's playbook, the strategy used by these massive financial giants to turn panic into profit during the 2008 crash.
The playbook is brutally simple. Wait for liquidation. When assets were liquidated globally during the 2008 crash, price risk was entirely eliminated because values had fallen so far that they could only go up.
There was nowhere to go but up.
Exactly.
Yep.
One financial giant, Blackstone, famously purchased 400,000 single-family houses across the U.S., often without inspections. They just acquired them at massive discounts, as low as 60 cents on the dollar.
They bought panic wholesale, and they did it at a massive scale.
That's it. They quickly packaged those mortgages and properties back into new securities and sold them for immense profit. Eventually, they were even selling mortgage-backed securities back to the Federal Reserve itself during quantitative easing.
So the core strategy is just waiting for maximum panic. When assets are being forced sold, price risk is gone, and then you buy massively and just hold.
You hold until the eventual restructuring and market normalization. And this strategy applies perfectly to the coming crisis cycle we've detailed. If that CRE time bomb detonates in 2026 or 2027, you will see a massive liquidation in U.S. regional banking assets, followed by massive sales of distressed real estate.
And that's why the $300 trillion global bond market is seen as the biggest single opportunity right now for those who have capital.
It is, and we've seen historical examples where this playbook works perfectly. Think about distressed Greek bonds or Sri Lankan bonds that were trading for pennies on the dollar after their defaults.
Right.
Those assets paid out 10 to 20 times the initial investment once the government defaulted, restructured, and markets normalized. The opportunity is always in distressed assets, whether it's government bonds, commercial real estate, or fundamentally sound companies that get dragged down by a banking crisis.
So if the next 2 years, 2026 and 2027, represent that peak crisis period, the bottom of the cycle, maximum panic, assets being liquidated, how do we, as informed learners, position ourselves to win the game? We need a clear, actionable Wealthnetic strategy.
This is where we shift focus from analysis to application. And the shift is entirely psychological and structural.
Okay, takeaway number 1.
Number 1, adopt the elite mindset. This means fundamental analysis over fear. You have to stop being driven by fear and hope. That's the mindset of the masses, and it's designed to keep you liquidating assets at the bottom and buying at the peak.
So instead, you need to understand that underlying system architecture we discussed.
The 4 pillars. The Western banking failure with CRE, the geopolitical competition and proxy wars, the tech divergence, and the debt restructuring through gold revaluation, your positioning has to be based on this fundamental analysis, not market noise or emotional reactions.
So we're moving from passively reacting to the market to actively anticipating the system's engineered reset.
Exactly. Remember the Rothschilds. This volatility isn't a problem to survive. It's the necessary prerequisite for the exponential wealth opportunity. Anticipate the system's needs.
Okay, that's the mindset shift. What's the second practical step?
2, manage liquidity and income intensely. You have to prepare for the bottom. The next 2 years will be defined by extreme difficulty, high corporate debt defaults, and mass business failures in the non-tech sectors.
So personal liquidity is priority number one.
Above all else, this means having ample cash reserves, 6 months, a year, maybe even more, to wait out the panic and be prepared to buy assets when others are forced to sell.
So it's not just an emergency fund, it's dry powder. It's an offensive weapon.
It is an offensive weapon, and you need to focus intensely on maximizing your income streams right now. A second job, a third, a specialized side hustle. You need maximum incoming capital to build the massive cash base required to deploy when the predicted mass corporate layoffs begin and business failures accelerate into 2027.
Because cash is king during a collapse.
Cash is the ultimate leverage when everyone else is desperate.
Okay, so you have this maximum liquidity. Now you need an asset to preserve its purchasing power through the systemic transition.
That brings us to the third point, the optimal transition asset, and that is gold.
Gold as the transition asset.
You must recognize gold as the #1 strategic asset during this transition. It's the only asset globally recognized by all competing geopolitical blocs, G7, and BRICS to back currency stability and debt confidence.
And the price performance we've seen this year, that's just the beginning.
It is. The analysis projects that gold will rise significantly, reaching a price range of $5,000 to $10,000 per ounce.
And that's driven by two factors, right?
2 factors. First, the necessity for the U.S. to revalue its own collateral to manage that $37 trillion debt. And second, by central banks like China and the BRICS allies accumulating it rapidly to back their own currency systems and get around the dollar.
So we should treat gold not as a final high-growth investment, but as a strategic tool for capital protection, a place to park purchasing power while the currency system restructures.
Correct. You hold gold to protect your wealth during the change, and then you convert that gold into distressed, heavily discounted assets, the CRE, the defaulted bonds, the blue chip companies dragged down by bank failures when the crash hits its bottom, likely in 2027. You convert stable value into liquidated opportunity.
And the final piece of the strategy, where do we point that capital for the next cycle?
Point 4, target new growth trends. This is about the new revolution. Do not chase the overvalued mega caps, the Magnificent Seven, that have already had their massive run.
So where's the real exponential opportunity?
It's in owning the foundational components of the next industrial revolution. You need to focus on foundational technology companies aligned with this global shift. Quantum computing infrastructure, analog AI systems, smart city technology designers.
So look for the smaller companies positioned to grow 10x by building the new global operating system.
Exactly. Rather than the established firms that need to double their already massive market cap for you to see a good return. We saw evidence in the sources of specific quantum infrastructure stocks that rose 10 times in a single year.
Which demonstrates the explosive, immediate potential in these foundational, high-growth sectors.
Find the companies that are making the tracks, not just the ones riding on them. The future world architecture is being built right now, and the greatest fortunes will be made by those who own the pieces of the new operating system.
We have covered immense ground today. We've explored the immediate financial risks from the CRE time bomb and the regional banking crisis, the deep structural flaws in Europe, the geopolitical shift driven by proxy wars, and that massive tech divergence as the U.S. and Chinese ecosystems permanently separate.
And this deep dive really confirms we are rapidly approaching the most challenging years, 2026 and 2027. But we've armed ourselves with a historical playbook. We understand that history requires a great crisis, a financial crash, widespread conflict, to allow for a total reset.
And the establishment of new rules and new winners.
Exactly.
The knowledge of this mechanism is power, but application is everything. If you accept this historical pattern, the question is simple. How prepared are you to maximize your liquidity now, protect your assets during maximum panic with strategic assets like gold, and which discounted assets will you choose to build your wealth for the next 100-year economic cycle?
Think like the controllers, not the controlled. Move beyond survival. The focus has to be on winning the game.
Thank you for joining us on the Deep Dive. If you found this discussion valuable, please share this deep dive with others who need to move beyond fear and start winning the game. We'll see you next time.